As the U.S. markets are closed for the weekend, we are looking at the closing figures for Rezolve AI, ticker RZLV. On Friday, October 31st, 2025, the stock finished the session at $4.29 per share. That was a solid move up of 20 cents or 4.89% on the day, with a notable 8.46 million shares changing hands. In after-hours trading, it tacked on a few more cents, rising to $4.33. Now, a nearly 5% jump on a Friday for a small-cap AI stock might cause most people to just lump it in with the general speculative noise of the tech sector. The common expectation is that this is just retail traders on platforms like Robinhood or SoFi Invest chasing the next hot narrative, a narrative that has already seen this stock fluctuate between $1.07 and $8.45 over the past year. But that expectation is fundamentally wrong. The reality of what's happening under the surface of RZLV is far more significant and reveals a stark disconnect between public perception and institutional action. While many are busy with Robinhood stock trading or looking at their Fidelity mutual funds, the real story here is the quiet, aggressive accumulation by some of the biggest players in the financial world. The assumption is that this is a high-risk, story-driven stock. And it is high risk, but it's not just a story anymore. In the last 3 months, institutional ownership in Rezolve AI has increased by a staggering 442.65%. That's not a typo. Fintel reports that 54 new funds have opened positions, bringing the total number of institutions on the books to 100. We're talking about names like Geode Capital Management, Northern Trust, and Jane Street Group building up their stakes. These aren't traders using the Robinhood app to buy Robinhood fractional shares. These are massive financial managers, the same ones who hold core positions in Apple stock and Nvidia stock, and they are making a very specific, calculated bet. They aren't buying the past, they're buying the very specific projection. This is the kind of online investment activity that warrants serious attention. Let's get to common ground. Most people who do look closer at RZLV see the recent earnings report from early October and get confused. The company reported earnings per share that matched estimates, coming in at a loss of 3 cents, but it missed on revenue. The expectation was $6.75 million, and the company delivered $4.88 million. In a market obsessed with top-line beats, a miss like that should have been devastating. This is where the deeper take, the reality, comes in. The stock didn't collapse. In fact, it spiked 25% on that news before settling. Why? Because the institutions and analysts who are actually steering this ship are ignoring that TTM revenue figure. They are focused on a completely different metric, annual recurring revenue, or ARR. Rezolve's management reported $90 million in ARR year-to-date, and most critically, projected they would hit at least $150 million in ARR by the end of this year. This is the entire bull case in a nutshell. The market is not valuing RZLV on its $5.3 million of trailing 12-month sales. If it were, the $1.3 billion market cap would be absurd. The market is valuing it on that forward-looking $150 million ARR target. If you value it as a high-growth software company, a price-to-forward sales ratio of around 8 or 9 is suddenly not just reasonable, but potentially attractive compared to peers. This is the expectation versus reality tension at its peak. The expectation is a company with tiny sales and a huge valuation. The reality is a company with an explosive triple-digit growth rate in contracted revenue, and that is what has firms using Interactive Brokers and Fidelity Wealth Management Services to build positions. The trading volume itself tells a story. While Friday's 8.46 million shares was active, it's well below the 90-day average of over 16 million. We saw days in October with volume spikes over 19 million shares. This isn't the steady, predictable volume you see in Fidelity ETFs. This is the footprint of accumulation, punctuated by high volatility days as buyers absorb shares. Analysts are certainly validating this view. Just last week, on October 29th, the average analyst price target on the stock was raised by over 36% to $10.79 per share. That implies more than 150% upside from Friday's close. Firms like Roth Capital Markets, Northland Capital Markets, and Maxim Group all have buy or outperform ratings on the stock. When you see this kind of uniform bullishness from the analyst community, combined with massive institutional inflows, it forces you to reevaluate the revenue miss narrative. It suggests the smart operators believe the ARR projection is not just achievable, but the key metric for this investment. So what does Rezolve AI actually do to command this kind of attention? This is where it gets interesting, as the company is really two businesses in one. First, there's Rezolve AI, which is an internal, generative AI-powered service desk. Think of it as an AI assistant for employees, living inside platforms like Microsoft Teams. It automates IT support, handles HR questions, resets passwords, and deflects tickets. For any large enterprise, this is a clear cost saver. But the second, and arguably much larger opportunity, is their external-facing Rezolve platform, specifically their Brain Suite. This is a conversational AI platform for retailers and e-commerce. It's not just a chatbot, it's a full suite of tools. Brain Commerce, Brain Checkout, designed to engage customers, guide them through sales with natural language, and process the transaction. This is the agentic commerce they keep talking about. And it's not just theory. The company reported that its platform has already processed over 13 billion API calls and 1.6 billion search sessions in the first 8 months of 2025. That is industrial scale. This isn't a startup in a garage. This is a platform that is working under a heavy load. Their growth is being fueled by key strategic partnerships. When you have Microsoft and Google distributing your product, you have a sales channel that a company this size could never build on its own. They've also landed major clients, like a multi-year deal with department store giant Liverpool, reportedly worth nearly $10 million annually. This is the proof point. It shows the Brain Suite isn't just a good idea, it's a product large enterprises will write million-dollar checks for. To bolster this, they've been making acquisitions, recently buying SmartPay and Subsquid, a blockchain data platform, to build out their AI-driven payment and digital asset network. They are building a vertically integrated ecosystem for AI-driven commerce. Many people doing self-investing might miss these details, but for a professional analyst at Fidelity or a trader using the Interactive Brokers platform, these are the material facts that support the bullish thesis. This brings us to the future outlook, and the risks are as significant as the potential. The number one catalyst is that $150 million ARR target. If they come out in early 2026 and confirm they hit, or even better, if they exceeded that number, this stock will likely re-rate significantly higher, and the current $4.29 price will look like a distant memory. Every new enterprise client they announce between now and then will serve as another milestone, de-risking that projection. The integration of their new acquisitions and any news from their partnerships with Google and Microsoft are the other major factors to watch. These are the things that could take it from a $4 stock to an analyst target $10 stock. However, the reality check here is the balance sheet. This kind of growth costs a fortune. The company's net losses have widened, and its last reported current ratio was around 0.22. That is a very low number, and it suggests potential liquidity challenges. They are burning cash at a rapid rate to achieve this growth. This is a race. Can they scale the ARR fast enough for the company to become self-sustaining, or will they be forced to raise more capital, potentially diluting shareholders just as they are gaining momentum? This is the central risk. Unlike a mature company like Tesla stock, which generates massive cash flow, Rezolve is in a completely different phase. The expectation is that AI is a magic wand. The reality is that it's an incredibly expensive business to scale. This is the ultimate high-stakes scenario. You have a company that is either on the verge of becoming a dominant player in AI-driven commerce, validated by huge institutional buying and massive recurring revenue growth, or it's a cash-burning machine whose projections are too optimistic. The institutions are betting on the former. The skeptics are pointing to the latter. The line between those two outcomes is that $150 million ARR number. Comment below if you think Rezolve can actually hit that $150 million ARR target by the end of this year, or if it's just management hype. For those looking at this space, whether through an individual brokerage account, Fidelity IRAs, or even a managed intelligent portfolio, RZLV represents the sharp end of online investing. It's not a set-it-and-forget-it stock for your Schwab intelligent portfolios. It's a high-information, high-volatility holding that requires active monitoring, perhaps on a platform like the Fidelity mobile app or Interactive Brokers' advanced Interactive Brokers trading setup. In summary, the story of Rezolve AI is the perfect example of expectation versus reality. The surface-level expectation is that of a volatile, speculative, revenue-missing AI small cap. The deeper reality is one of explosive triple-digit recurring revenue growth, massive institutional accumulation,